Okay, so good morning, everyone. Welcome to the macro snapshot. We are Friday, April the 11th, 2025. No camera today. Okay, so what I want to start off with, guys, is just look at how some of the normal correlations are sort of breaking down. And what we can see on this chart here, if you look on the yellow, this is the euro versus the US dollar, which we see is having a very strong performance. So euro going up, you see here on the right-hand side. And what we have in the white line, which is inverted, so you see the values going 1.4, 1.6, so inverted values, is that normally this obeys the differentials, which is to say that as the differentials go in favor of the US dollar, the euro goes down and vice versa. But what we're seeing here is that the differentials, you see they're actually blowing out a little bit, which is to say that the US 10-year yield is higher than the Bund 10-year yield. But instead of the euro actually sort of suffering, so to speak, or going down, we see actually it's going in the opposite direction. So this is really saying that it's no longer sort of naively trading on the differentials, but really is something else. So then, if we can see that, just to look a little bit here at the strength in the currencies this morning. Let's have to start off by looking at the currency action. And if we look at the dollar index, which of course is 58% euro, we can see that the dollar actually has been sort of selling off quite a lot, but it hasn't been selling off sort of equally. It's just finding a little bit of bounce here as to some support. But really, what we can see is that, let's say, for example, the yen. You can see here the US dollar versus the yen, probably going to go down all the way down to 140, so safe haven there. And then also particularly against the Swiss franc. So look at the Swiss franc here. You see the Swiss franc is just powering ahead, and you can see that that just continues to sort of continue downwards in terms of the USD Swiss franc here on the spot. So this is now in no man's land. So definitely here. From a sort of a macro perspective, no reason to be sort of long the US dollar against the Swiss franc here. And part of that is because the dollar is losing its kind of safe haven sort of status. And if we actually look here, just want to bring in something which is kind of interesting. If I could just find it here, it's just like volatility. And we've got here, just looking here on the daily shot, kind of an interesting chart which really explains this quite well, is that if you go back and look at the VIX and you go back to, let's say, periods of extreme sort of stress in the market where you're up to, sort of 70 or 80 in the VIX. So you go back to the great financial crisis in '08, or obviously in COVID. And at the moment, we're not quite at those elevated levels, but we have been, in the 40s and 50s. You can see here that the US dollar has basically been, this is the currency change over 1 week. You can see how it's gone up 4% or, 3%. But again, as the question mark is showing us, nothing at all. And so it's interesting that really the safe haven flows at the moment really going to the Swiss franc, just this uncertainty, and the Japanese yen, and really the US dollar is not performing its function. And that's just because I think there's been a lot of repatriation out of US denominated sort of assets going back towards Europe, maybe Japan as well. And there's just some of the uncertainty. So if we actually look at some of the uncertainty, just thinking about it, we've got overnight just a few different comments. We have from a trade sort of advisor, Pete Navarro. He was basically saying there are some trade deals on the way from Australia, UK, India, a little bit of optimism there, possibly. So you're doing some deals. On the other hand, China overnight basically put their tariffs up from 84% and I'll just bring up the stocks here while we're looking at it. So they went from 84% up to 125%, just looking at the ES here. But they basically said, quote unquote, these were kind of a joke at this point, what the US is doing. And so they've capped their maximum tariffs at 125% because for all intents and purposes, this doesn't make much of a difference. So really what we're seeing here is that the market is caught, and we again start looking at the stocks here. You see that overnight price action. If you actually look at the last couple of days here, you see that the stocks bounced up to a sort of a technical level of overhead resistance. They've come down, and now overnight, really, they're not quite sure what to do, because there is a sense that maybe there are quote unquote sort of deals on the way, but there still remain a lot of uncertainty in the market. So I think just a lot of market participants are sort of putting their money in the Swiss franc or the yen, and obviously, of course, also in the gold. Let's have a look at gold. So if we look at gold here, just looking at something, gold made a new high overnight, now pushing up to about $3,200, just relentlessly pushing up. Interesting to compare that with something like silver. So we see that silver on the back of that is getting a bid. So silver is a little bit in the middle, as we know, about 55% of silver usage is for industrial purposes. So gold is still outperforming silver here. If we look at copper, copper also doing okay, but I don't know if that's really sort of optimism. There is some sort of talk about sort of China's stimulus on the way. But really, if you actually look at what's happening, is that on this huge sort of dip here, this complete crazy sell-off here, a lot of traders came in and actually bought the dip in terms of the physical copper, because I was just looking this morning, the copper inventories in the Shanghai warehouses have actually sort of collapsed. So basically, a lot of physical copper was bought on this dip by traders hoping to sort of arbitrage that. And we're seeing that the front contracts are starting to go into backwardation as well. So I don't know how sustainable this is from a sort of a fundamental point of view. I think traders were buying this dip here and hoping to get sort of news of a Chinese stimulus. What we do have today. Just looking out, we do have some data, so kind of interesting just to see. First of all, let's just review the CPI yesterday. So what's actually kind of interesting is that in theory, and again, I'm just going to use the daily shots, easy form here. The CPI sort of month over month actually went down a little bit here, and you can see that the core number actually didn't go up that much at all. So it's kind of sort of starting to go up by less and less. So, question mark, is this, something sort of positive for the Fed to hold on to? And what we can see is that, wasn't too bad. If we look at the core goods as well, services are still elevated, but core goods actually starting to go down. And if we look at the services, this is quite encouraging. It went up, the services month over month, but the core services, which has been the big problem. But as you can see here, not as much as previously. So let's see if this is some kind of sort of trend. But in terms of what's driving the Fed, looks as though the Fed is on hold. Let's just see where it looks like we're at about sort of 3.5 sort of cuts priced in. And there wasn't actually that much market reaction. If you go to December here, you can see 3.6 cuts priced in. And basically, the market quite liked, just for a few minutes, the CPI, but then it got back to the business of, tariffs and international trade and uncertainty. And the Fed at this point really was interesting. We've had a few speakers over the last 2 or 3 days, and most of them have been saying, which I think is quite hawkish. They've been saying that on the two mandates, that they're really their focus is still on the inflationary pressures and the danger that medium to longer term inflation might start ticking up. So I think if we had to take away anything from the Fed speak over the last 2 days, it's been that, okay, inflation maybe is stabilizing, but they're still quite concerned and very concerned about the potential effects, inflationary effects of the tariffs. And so that's why at the moment we seem to be stuck in about 3.5 cuts. What we do have today, we do have in terms of Fed speak, we do have a couple of speakers, including Williams from the New York Fed. That's quite important here. So let's see what Williams has to say. We also have a bit of data. Again, it's going to be interesting that we have the PPI in about half an hour or so, just to see if the input prices here actually confirm the CPI, which we had yesterday. But again, this is backward-looking data for March, and of course, all of these prices, one could argue, are completely outdated. What also could be of interest to the market is University of Michigan. This is preliminary for April. So this is a little bit more sort of recent. I mean, again, it's not data, it's a survey and a bit of a problematic survey. But what we have been seeing recently is just the trend, we could say, for inflation expectations. You see here the 1 and the 5 to 10 year. You see how this went from 5 to 5.2 and then 4.1 to 4.3. So this is what the Fed is worried about, that these inflation expectations, people are sort of starting to get a bit nervous about the future. And could that go up a little bit? Also, just current conditions and sentiment in general. So what the market does not want to see is a continuation whereby sort of sentiment is going down, but expectations for inflation is going up. On the other hand, we did have this morning, we have some banks. So we have Wells Fargo, BlackRock, we have Morgan Stanley and JP Morgan. We've already got the JP Morgan and Morgan Stanley. And you can see I had a quick look at the numbers just before doing the video here. And both of those seem to be pretty good, quite good results here from JP Morgan and Morgan Stanley. Although Jamie Dimon from JP Morgan did come out and say that he was quite concerned about the potential for downside in the economy going ahead. So a little bit sort of nerves there. Just in terms of some other things, just want to look at the curve. And what's pressuring as well, just it's interesting just to keep in mind, what's also pressuring the stock market, and this gets back to that earlier point I was trying to make about the dollar. The dollar is no longer serving as a sort of a safe haven in this times of market stress. So a real sort of diminishing or lessening of confidence in the US sort of, how can I say, sort of financial assets kind of sort of space. And that's not being helped as well just by the term premium going up and the yields going up. And we can see this here. This is the US yield curve. And you can see here, so we've got like 1 month, 3 month, 1 year, then all the way out, to the 30-year tenor. And just sort of interesting to look at this, let's say compared to now, compared to a week ago. And we'll just wait for that to load. So you can see this is now the green line, and you can see that overall all of the yields have gone up quite substantially. And you can see here, but really what's happened is that hasn't been so much at the very front end of the curve, and that's essentially signaling that any problems the Fed might have to come into the rescue and reduce rates. But really the problem here is just this sort of concern still about inflation, concern about the term there's the risk in the market and lack of liquidity, and you see here just where like something like from the 7 and the 10, the 20 and the 30, so really the belly to the long end of the curve has gone up 30 or 40 basis points here. And the problem here is that if the long-term bond yields are going up so much, this is just not good for risk assets in the form of stocks. And that's why I think, even though one could argue there is some potential sort of a progress, so to speak, Trump seems to be calming down a little bit. We can still see just in the stock markets, if we just again have a look back here, we can still see that the stocks are just finding it, even though we had good bank earnings just coming in half an hour ago, the stock market finding a little difficult to have a strong rally. What could be interesting today is something like the Dow Jones, which does have a couple of the bank stocks in there, JP Morgan and Goldman Sachs. Maybe that's going to outperform a little bit. Again, if we look over towards Europe, let's just look at the FESX. You see, again, not doing particularly well. And that just didn't like at all some of the news from China, the fact that China is a very, very important sort of export market, obviously, for European goods. And the European stock market overnight did not react at all well to the news that China is ramping up the tariff pressure on the US. And probably even more importantly is that the Chinese rhetoric and the American rhetoric is not calming down. And so the possibility for a swift sort of negotiation and cessation of hostilities is maybe a little bit further away. There just doesn't seem to be great communication at the moment between China and the US. And that's not good for Europe in general. Although what is interesting, as I said, is that the euro is doing particularly well. So that's about it there, guys. I just want to look quickly also at oil. Oil, as we saw, had a little bit of a bounce. But again, just finding it difficult to get above sort of any kind of Fibonacci retracement or anything like that here. And oil, it probably is going to be stuck down here. It might actually just range until and unless we get some clear sign that global growth is picking up, and probably more importantly that the tariff war has been substantially reduced. And just what I would just want to end on the tariff situation here is just a little bit of context here. And I have to find again, where are we? Yeah, just while we've got these charts up as well, just talking about the US economy, it was interesting that the very discretionary services like travel and tourism, and leisure and restaurants, this is normally very sensitive to spending. You can see here this was going down in the States. So I just wonder if this is an early signal that people, consumers in the US, are getting a little bit nervous and are starting to spend less on these discretionary items like travel, tourism, restaurants, leisure. So that's an interesting one to watch. And that was definitely down in the CPI. But what I wanted to look at is actually, if I could find it, sorry, just give me a second here. It's yeah, just this whole question of tariffs, and it's interesting. We can't, and this is why the stock market, I think, is finding it ultimately difficult to have a sustained rally, and we're in a much more of a sell rallies rather than buy dips kind of situation. Because if you look here, even if so you've got the 10% on all imports. And remember that Trump didn't remove everything the other day. We still have a 10% base level, as you see there. And then if you add it, the huge tariffs on China, but you assume a 50% reduction in imports, that is still having a pretty nasty effect. Like a lot of stuff goes from China to the US. So even if that's reduced, which it hasn't been. That's still very significant. And then you have to throw in the other ones like, on automobiles or aluminium, steel, et cetera, et cetera. So the point we're trying to make here is that from a historical point of view, this is a year, okay? So this is 1940, 1960, 2020. Whichever way you cut the cake here, whichever way you cut the cookie, we are still at historically extremely high levels, much, much, much more than we had going back to even, we have to go back to, like the 40s, like during the Second World War, or even in the 60s, and probably more realistically going back towards the 1920s and 40s and 30s, where we had the Smoot-Hawley Act in 1930. So that's something we haven't seen for 100 years. So I think until and unless some of these levels can go back down to more historically normal levels, down maybe here or something, like 5% or something, it's just going to be difficult for the market to show any optimism. Okay, I'll leave it there, guys. I'm going to wrap it up. Again, let's keep an eye out for the PPI University of Michigan. Personally, I'll be keeping an eye on John Williams from the New York Fed. Just interesting to see if he's gives us any insight into what the Fed may be speaking, because in the past he's been pretty much of a good indication of what Powell himself is thinking. Okay, I'm going to leave it there. Sorry for the camera not working. We shall keep the conversation going. Thank you.